All right, and next up we have Professor Larry White here to talk about Reserve's Endgame plan and to look at that in a broad lens of comparing gold, Bitcoin, and asset-backed currency. Please join me in welcoming Larry.
Yeah. All right, thank you. It's an honor to be here. It's an interesting project, well, set of projects around the Reserve protocol that I want to talk about. But let's start at the beginning, sort of put it in context. Yesterday we talked about Plan A, and to an economist, Plan A is represented by the classic case for rules rather than discretion for monetary policy, as enunciated by Kydland and Prescott back in the 70s. But at the same time, people were beginning to talk about a Plan B, and in particular, Friedrich Hayek, who had just gotten the Nobel Prize in economics, and that sort of awakened him. He hadn't written much about money since the beginning of Bretton Woods, because he was on the outs with the status quo. But he figured, well, maybe now there's an audience for what I have to say. And the question he raised, because he was living in Europe, but he had spent a lot of time in Great Britain. In Great Britain, there was 20+% inflation in the late 70s. In the US, of course, we hit double digits. And Hayek said, we need better quality money. And to get better quality money, we need competition. I'll come back to his idea in a second. But we had the great moderation after the double-digit inflations. But 2022, we got back to double-digit inflation in Europe and nearly hit it in the US. But around the world, lots of countries have much higher inflation. 43% of countries globally had inflation above 10% in 2022. That was, of course, the pandemic year, and so it was kind of a special case. But it's a reminder that there's nothing tangible that restrains inflation under our current regime other than good behavior by the central bank, and we can't, and especially people in many countries cannot, depend on good behavior by central banks. So I've highlighted in yellow the countries with triple-digit inflation, and there are lots of countries in high double-digit inflation. And competition already exists in those countries in the sense that people put themselves on a better monetary standard to the extent they can. And the US dollar has been the most popular alternative. So if you look at the countries with triple-digit inflation, Venezuela, Lebanon, Zimbabwe, Argentina, Sri Lanka, Sudan, dollarization on an unofficial basis, bottom-up dollarization, is extensive. More than 80% of savings are dollarized in Venezuela, Lebanon, Argentina, and pricing of big-ticket items is almost entirely in dollars. So back to Hayek, because he kind of reintroduces this idea of thinking about the monetary standard and how the supply of money is governed. Instead of governing it by a monopoly, let's think about letting competition in. Let people have access to other currencies that are better than the one they're currently suffering from. His first proposal was just let people use fiat monies from whatever country in the world they want. So people could use Swiss francs, those would be better than British pounds. But then he said, well, why don't we open the competition to private enterprise? You know, money has been monopolized by governments going back centuries, but there's nothing necessary about that. Money has been and can be provided in the private sector. Traditionally, there were private gold mints. There were private banks issuing gold redeemable banknotes and deposits. Systems worked quite well without central banks. just through the incentives provided by and the legal constraints provided by the obligation to redeem for gold and the natural scarcity of gold. Hayek says, well, I don't envision that happening again. And so he doesn't think the gold standard will come back from the bottom up, but he imagines a world in which private firms issue their own currencies. Begins to sound a little familiar. But he envisions them promising stable purchasing power. He thinks that's what the public wants and what they're not currently getting. So he imagines private issuers issuing irredeemable currencies, not bound by any contract to redeem them for gold or for a basket of commodities or anything else, but simply constrained by the competitive pressure to issue a reputable currency. If you stop doing that, if the inflation in a currency starts to rise, the customers will abandon it for some other currency. And that's the mechanism he imagines would discipline money issue. I think there are a couple of things he didn't adequately address in that proposal, because that's not what we've seen happen with the reemergence of competition among currencies. So the problems are, without a contractual commitment, without a redemption or a quantity guarantee, there's an opportunity for an issuer to make a big profit by what we nowadays call a rug pull, by a hyper expansion of the quantity. If people will take it at some positive price, keep issuing it and buying stuff with it, and leave people holding a currency which is eventually diluted into worthlessness. It's a one-shot profit, that's true. You go out of business after that. But if you make a big enough one-shot profit, it's worth it, rather than staying in business and making a normal rate of return. So he didn't really grapple with that issue well enough. But secondly, there's a network property to money. People want to be paid in something that they know they can turn around and spend, that they're not going to have trouble getting it accepted somewhere else. And so that's an obstacle to there being dozens of monies in a single city, which is the picture he's imagining. In the second edition, he recognized that point and said, you could have different issuers adopt the same basket of goods as the price index to which they promise to maintain stability. But if there are floating exchange rates among different currencies, that's a hassle for the users of money. But competition has arrived. So this is a Venezuelan web page on the Latin American version of Amazon called Mercado Libre. So this seller says, here's how you can pay me. So there are at least 4 different monetary standards here. He'll take bolivars, he'll take US dollars via Zelle, or via Tether. He'll take Bitcoin, he'll take Binance Coin. So the motive here is, one, that the Bolivar is not a good currency, but he also accepts payments in Bolivar at the right exchange rate. The other motive is, if he wants to make cross-border transactions, it's actually sometimes cheaper to use dollars or Bitcoin rather than try to use the legacy foreign exchange system. But we're all familiar with the new entrance into the competition among potential monetary standards. There are endless debates on X about whether Bitcoin is a money. I don't want to get into those. But let's just say it's a potential commonly accepted medium of exchange. It's not there yet. There are people who use Bitcoin as a medium of exchange, that is, they acquire it in order to transfer it to somebody else, but it's not very common. Opportunities to spend Bitcoin are limited. There also has been a reintroduction of kind of private gold standard in the form of digitized gold, Tether gold and Pax gold. Now notice the order of magnitude here is much tinier than Bitcoin. These guys have about, put together, have less than 2 billion. Bitcoin is 2 trillion, last time I looked. But those options are both out there, and there are sort of gold-based banking, not on-chain, but gold transfer services available. There are, of course, other coins available, but none of them really has the reach of Bitcoin or the potential, or really the ambition, to be a commonly accepted medium of exchange. Whereas Satoshi envisioned Bitcoin being used as a world money. Problem: the design of Bitcoin is not very friendly toward its being a commonly accepted medium of exchange because of the choice Satoshi made to make the supply of Bitcoin pre-programmed. Right? There's a release schedule that's built into the source code, and the quantity of Bitcoin has been growing along this path. So we know how many Bitcoin there are today. We know within a percentage point how many Bitcoin there are going to be at any date in the future. And that means that the supply doesn't respond to the demand. If there's an increased interest in acquiring Bitcoin, it doesn't make any more Bitcoin available. And that means the price absorbs the entire impact of any change in demand. Quantity doesn't budge. It just continues along the path it was already on. And doubts were expressed very early on by Vitalik Buterin, for example, about whether this would be suitable for a commonly accepted medium of exchange because it implies price volatility. Now, forgive me for getting a little technical, but I'm going to come back to this analysis. These are supply and demand curves. So I hope you've had Econ 101. What I'm trying to illustrate here is, by comparison to, let's say, the classical gold standard, this idea of a vertical supply curve for money means that shifts in the demand curve from curve 1 to curve 0 is entirely impacted, entirely absorbed by a change in the price. No change in quantity. Whereas in a gold standard, for example, one example of a commodity standard, there is some flexibility even in the short run because there's lots of gold in non-monetary form that will be melted down and coined as the purchasing power of gold goes up. Right? As purchasing power of gold goes up, it becomes more expensive to have gold knives and forks or gold picture frames or gold jewelry. And I used to think this might be of trivial empirical importance, but the World Gold Council says that about 1/3 of all the supply of gold into people who are going to make stuff out of gold, either coins or jewelry, comes from what they call recycling, which means melting down old gold. So it actually is important. And so there's some increase in the quantity of monetary gold through conversion from non-monetary gold as the purchasing power of gold goes up. And that means there's less increase in the price of gold than there would be if the quantity were absolutely fixed. So when I hear people say Bitcoin is an electronic version of gold, they're thinking that, well, they're both inflation hedges. Okay, but the supply mechanisms are very different. So Bitcoin's not an electronic version of a gold standard when we think about the way it's supplied. So that was in the short run, where you're just dealing with the existing stock of gold and converting it from non-monetary to monetary. In the long run, if the purchasing power of gold is high, that incentivizes more gold mining. You get more ounces per year coming out of the mines. And if the cost of extracting gold doesn't change much, then neither will the purchasing power of gold. PPM here is purchasing power of money. Neither will the purchasing power of gold in the long run. And that is what you see in the historical record. I'll come back to that at the end when I talk about alternative monetary standards in a world without dollars. But the supply curve is nearly flat in the long run, so it's all absorbed by changes in the quantity. And that keeps the purchasing power stable in the long run. And that makes it an attractive medium of exchange, and especially makes it an attractive medium for denominating 10-year, 20-year, 30-year bonds. Under the classical gold standard, there were in fact 50-year and even 100-year bonds. You don't find that under fiat standards because who knows what the dollar is going to be worth 50 years from now. All right, but in the case of Bitcoin, we see it in figures for price volatility. So this is 60-day volatility. How much does the price move within a 60-day window in percentage terms? And it's much higher, 4 times as high as the volatility of gold to US dollars. AU is the chemical symbol for gold. And more than the euro to dollar exchange rate. And that makes it unattractive as a medium of exchange. Especially if you have payments to make in dollars, you got rents to pay and you got utility bills to pay, you wouldn't want to keep that money in Bitcoin. It could fall dramatically the day before your bills are due. Now, the one place that Bitcoin was widely adopted as a medium of exchange was in crypto markets. So it used to be that if you wanted to sell Ether and buy Litecoin, you would first buy Bitcoin and then use the Bitcoin to buy the Ether. That's no longer true. It's now stablecoins. It's US dollar tether that has taken over that market. And I think as a response to traders not wanting their liquid funds after they sell one asset before they buy another to be so volatile. And so I see this as a market expression of a strong preference for a more stable valued medium of exchange. Strong enough, over short holding periods especially, strong enough to overcome the fact that, the average return from holding Bitcoin is higher than the average return from holding Tether. But the risk is much lower from holding Tether, risk of a drop in value. We also see it in the transactions volumes. So Tether's market cap is, last I looked, 155 billion versus 2.1 trillion. Right, so less than a tenth, and yet the transaction volume is double what the transaction volume in Bitcoin is. And of course, the transactions in Bitcoin are mostly buying and selling Bitcoin. All right. So that's all kind of by way of background. In order to imagine a world in which we've replaced the dollar, we have to imagine that people wanted to get rid of their dollars, and that suggests that the dollar has cracked up into high inflation. The dollar has gone the way of the bolivar or the Argentine peso or some other unreliable currency. If that happens, so I don't expect any sort of bottom-up replacement of the dollar unless it messes up in that way, unless we get, 20% inflation with not much prospect of it going back down. In that case, what replaces it? So in my book, here's the cover, published 2 years ago now, I considered gold and Bitcoin as the alternatives. Today, I'm going to consider other asset-backed currencies. And in the book, I argue that, look, gold has some advantages over Bitcoin in that there's actually more gold in circulation than there is Bitcoin. The $13 trillion figure is all the gold above ground, including jewelry. If you just look at monetary gold, so you take out jewelry and you take out industrial inventories, and then you have central bank holdings of gold, IMF's holdings of gold, and what's actually bigger than those put together, private holdings of gold bullion and coins, that's about 6 trillion. So it's a subset of total above ground gold, but it's still bigger than Bitcoin. Not as much bigger as it used to be, but it's still a multiple. And so it's got more of an established base. But I think more importantly, the purchasing power is less volatile. We saw it was like a fourth of the purchasing power volatility of Bitcoin. Bitcoin has some advantages over gold. It's peer-to-peer, so you don't need an intermediary. Although most people keep their Bitcoin on an exchange, which bringing back an intermediary for reasons of convenience. You don't need to do that. It's got a better payment infrastructure than digital gold does so far. So Tether Gold and Pax Gold aren't really designed for you to use it as a payment medium. They, for some reason, have adopted a model where they just want you to hodl it. There's no cost, there's no fee charged for just keeping your gold there. There's no storage fee. But there is a fee for getting in and there's a fee for getting out, which means you're not going to use it for frequent transactions. If somebody wanted to get people to put themselves on a gold standard, they would want to structure it differently. What Bitcoiners always tell me is, look, the reason the gold standard ended was that governments decided to seize all the gold, and if the gold standard resumed, even from the bottom up, they could do that again. And it's true that Bitcoin is a little harder to seize entirely. People could keep their holdings more private. There's no vault that the government can go to. But governments can drive Bitcoin underground if they're determined to do that. So in China, there are still people who make payments in Bitcoin. There is still Bitcoin mining, but less than there was before it was outlawed. And making it illegal for people to post prices and say, we accept payment in Bitcoin, is enough to keep it from being a commonly accepted medium of exchange. And it's only people who are sophisticated enough to operate on the dark web, basically, who are going to keep using it. But there are other possibilities, which in my book I only kind of hinted at, that I want to consider more fully today. And what another crypto design would need to be commonly accepted as a medium of exchange is a stable purchasing power, at least more stable than the dollar, more stable than gold or Bitcoin, and some reliable commitment mechanism. So people have to believe that the value will remain stable, that the peg won't be dropped, that it won't be devalued, or that the quantity won't explode. Okay, so the concern with stablecoins, right? So stablecoins, I just mentioned, have replaced Bitcoin in crypto markets. But stablecoins are only as stable as the fiat money that they're pegged to, and sometimes less than that, if the peg is a little shaky. So can't we do better than that? And that's given rise to the idea of having a coin that keeps up with the price level, a coin linked to the CPI somehow, that will preserve its purchasing power over goods and services better than a dollar will. So who's trying to do that? Well, Spot, Nevin mentioned the other day, Spot is tiny. 1.3 million is the current market cap, but hey, they're trying to do something. It's a kind of complicated arrangement that doesn't, it is a little mysterious, but Spot is a claim on a portfolio of Ampleforth assets, and Ampleforth is pegged to the CPI in that when the CPI goes up, you get more ample forth in your account. So the quantity varies, and when demand and supply go up, when demand for the coin goes up, instead of the price going up, because the price is supposed to be pegged to the CPI, you get more coins in your account. So that's the same sort of structure money market mutual funds have when they peg their share price to $1. But it raises the concern that because we've seen coins that were paired with other coins before, and it didn't turn out well. International stable currency, which I hadn't heard of until I started searching for who else is issuing flat coins. It's a little bigger, 2.2 million, and they just kind of arbitrarily said, here's our portfolio. 20% equities, 20% gold, 20% international bonds, 20% T-bills, 20% cash-like. No reason to think that's an optimal portfolio, but let 100 flowers bloom. A third thing you find when you Google for flat coins is Nuon, but Nuon seems to have faded away. So that kind of pegging arrangement where how much you get depends on, you get more when the CPI goes up so that you preserve your purchasing power. That's one model. A second model is having a supply mechanism that responds to the CPI, not through pegging, but through quantity adjustment. And so the model here is the one I showed you of the gold standard. When the purchasing power goes up, it incentivizes more mining in a gold standard. You could replicate that by having a code that, when the purchasing power goes up, will issue more coin to bring it back down. And as Nevin correctly mentioned, when the purchasing power goes down, you want to issue less coin. And in an extreme case, you need to actually call in coin and burn it. And that is challenging if you don't have a redemption fund. But that's the model that's being built into Saga Coin, which, disclaimer, this is why I have purple beads on my bracelet, I'm consulting with. So basically my suggestion to them is make the supply behave like the supply of gold under a classical gold standard, but with faster adjustments. Right? Estimates of the classical gold standard suggest that it took about 20 years for the new mines to be put into operation and for the gold to accumulate enough to return the purchasing power of gold to its trend. We can program a crypto to behave more rapidly than that. All right, but there are all kinds of new flat coins that are possible with reserve protocol. And I think we have to divide between the short term and the long term, where the short term is in a world where the dollar dominates, what would be an attractive alternative. And secondly, if we want to think about a world where the dollar has shrunk into insignificance, what would be a durable kind of design? So in a world where the dollar has shrunk into insignificance, indexing to the CPI is not going to work because the CPI is measuring dollar prices of goods, but if nobody's using the dollar, what good is that? So in the short term, while the dollar exists and while people have most of their obligations denominated in dollars, they will want something that holds its value better than the dollar. And so it raises the possibility of backing with something that is linked to the CPI. And so backed with CPI-linked assets seems like a natural idea. What kind of CPI assets have we got? At one point, there was a CPI futures market opened in 1985, never did very much volume, and they eventually closed it down. Just wasn't worth having. Nobody seemed too interested. Partly it was bad timing because 1985 is kind of the beginning of the great moderation where inflation risks seem to have gone away, so people weren't too interested in hedging their inflation risk. But in the late 90s, we got Treasury inflation-protected securities, or TIPS. Right? So these are bonds, if you're not familiar with them, that are indexed to the CPI. So when the CPI goes up, the amount of coupon payment you get goes up by the same percent. And when the bond matures, they compare the CPI on that day to the CPI on the day you bought it and compensate you for the inflation that happened in the meantime. So it preserves its value in real terms. It's providing a kind of insurance against inflation. And you have to pay for that insurance, so the yields on inflation index bonds are lower than the yields on ordinary bonds if inflation behaves as predicted. But if inflation is higher than predicted, you're better off with the inflation index bonds. Now, if you want to build a portfolio of inflation index bonds, the TIPS are issued in 5, 10, and 30-year maturities. But a portfolio of 10-year bonds has a lot of interest rate risk in it. That is, the present value of the bonds, the price they're selling at today, goes up and down with interest rates. Well, when interest rates go up, bond prices go down, right? Because a claim to a fixed set of payments, coupon payments and final payment, isn't worth as much if you're discounting it more heavily. So to reduce that kind of risk, that's the risk that killed Silicon Valley Bank, by the way. They were holding a portfolio of 20-year bonds, and interest rates went up, and their bond portfolio crashed in present value. If you want to reduce that risk, then you want to hold a short duration portfolio. And we have a model of that in the real world. Here it is. BlackRock issues an ETF called iShares 0 to 5-year TIPS bond ETF. So they only buy 5-year TIPS bonds, and they hold them for a while, so their maturity is getting shorter and shorter. They're approaching maturity date. And the portfolio as a whole has a duration of about 2.5 years. So here's a chart from their webpage of growth of hypothetical $10,000 since inception. And you see it went through a period of being pretty flat, but in recent years it's done well. If you look over different horizons, did real well last year. 3 years, not too bad, a little bit more than inflation. Over 5 years, more than inflation. Over 10 years, pretty close to the inflation rate. Inflation over the last 10 years has been about 2.6% in dollars. So it has held its value over any of these horizons. You go back even further so that you get into this period, not quite as much as inflation. But it seems to be pretty solid, providing a return that outperforms inflation. If you look at the risk of the returns, it's pretty low. You compare that to a longer duration portfolio, it's about half. Here's another testing the outliers, the worst cases. In the worst quarter, it lost 2.6%. So it's not a perfect inflation hedge, but pretty good. And currently the real yield is, that is yield after you subtract inflation, is positive. All right, so that's a promising start. Can we do better than that? I discovered that there was research on this about 20 years ago. Before I say that, before I get to that, we have to recognize that, you know, for a TIPS portfolio to be a good inflation hedge, it has to continue to be trustworthy. And if we're talking about building a vehicle that will take us through a choppy era of high inflation in dollars, and if that high inflation is being driven by a fiscal crisis, such as we talked about yesterday, where the Treasury's last resort to paying its bills is to have the Fed print the money to do so, which is a common scenario in countries that have high inflation. That's what's driving it. Then you have to ask how reliable are any Treasury bonds. So even if they don't outright default on TIPS bonds, they could start monkeying with the CPI they use to adjust the payments. That's a common experience in countries that have high and volatile inflation. And they could just decide to stop issuing TIPS bonds. And some countries that used to have inflation index bonds stopped issuing them. And I haven't looked into those cases, but if they become too expensive, government may just decide to stop issuing them, and then you need to find something else to put in your portfolio. All right, but suppose for the time being we've got a portfolio of short-term TIPS bonds. Can we do better than that? And as I was starting to say, I discovered some people had done research on this. In particular, Kotari and Shanken. Their approach, or the question they were addressing was kind of the reverse. They were trying to persuade people that if you have a portfolio that's all S&P 500 index, you can improve it by adding some TIPS. You can get some greater, you can reduce your risk without impinging your return much. But they considered portfolios that went from 0% TIPS up to 100% TIPS. So we can look at it in the other direction. If you start with a portfolio that's 100% TIPS, what do you gain by adding, let's say, 20% stock index? And so the relevant numbers here I've circled. So the standard deviation of the portfolio, in the case where they've got two different scenarios, one where bonds, ordinary unindexed bonds, carry an inflation risk premium, IRP, and of 50 basis points, and one where they don't. In the scenario where there's no inflation risk premium, adding 20% stock index actually reduces the standard deviation of the portfolio, it doubles the Sharpe ratio, which is the ratio of return to standard deviation, because it doubles the return from 1% above the risk-free rate to 2% above the risk-free rate. So that's a clear win-win. If you go beyond to 40% stock index, 60% TIPS, it doesn't change the Sharpe ratio. It does increase the yield, but it also increases the standard deviation. In the scenario with an inflation risk premium, it's similar. There's basically a small drop in the standard deviation. Same drop in the standard deviation. Likewise, an increase in the Sharpe ratio, but the Sharpe ratio started lower. And the excess return increases by about a percentage point similarly. So that's my proposal for somebody who wants to run with it. Go for it. Build a token backed by 80% TIPS and 20% stock index and see if anybody's interested. It should do well. One thing to be concerned about in a world where the dollar is still dominant, though, is the cost of making payments. If people are going back and forth from an asset to dollars and back again to the asset, they're incurring exchange rate costs, and those can discourage the use of something as a payment medium. makes it hard to grow the population of people using it as a payment medium. All right, well, gee, I'm out of time, but I wanted to talk about some longer term ideas. Going back to the late 19th century, people were worried about instability in the purchasing power of gold under a gold standard. Even though the long-term trend was good, there were short periods of volatility. An economist named Alfred Marshall said, if the relative price of gold is changing as a result of supply discoveries or demand shocks, and in his day, the biggest demand shock was Germany decides to leave the silver standard and join the gold standard, we can diminish the impact of that on the purchasing power of gold by redefining our monetary unit so the pound would not be defined just in terms of gold, but so much gold plus so much silver. This is not bimetallism. Bimetallism is so much gold or so much silver. This is so much gold plus so much silver. So you got two metals defining your unit of account. And that's a kind of gateway into having a whole bundle of commodities define the unit of account. But this is kind of a minimal change because it still would have allowed there to be physical coinage for people who wanted it. A commodity reserve currency is an idea that became popular in the Great Depression, but was kind of rediscovered when the problem was not collapsing demand, but rather, and so the need for a way to get the money supply to grow. That's what the original idea of the commodity reserve currency was. But the reverse problem of excessive inflation, and so linking the dollar to a basket of, or whatever the unit of account is called, to a basket of currencies would be a way of preventing excessive inflation. And our friend Hayek, from 30 years before denationalization of money, saw some merits in this kind of proposal. It had the benefits of a gold standard in taking the regulation of the quantity of money out of the hands of a committee of central bankers, and is, in a sense, putting it into the market, because anybody could bring commodities to the warehouse and get money. Anybody could bring money to the warehouse and get commodities. But the proposals in the 30s and 40s were for physical warehouses filled with physical commodities. We don't need to do that today. We could accomplish pretty much the same thing with a portfolio of tokenized commodities. Let me leave with this one caution about that kind of arrangement. It's important to have a broad basket of commodities and not to pick the basket and the weights on the items in the basket by looking backwards and doing a grid search for what best matched the CPI. And I say that because an economist named Robert Hall said, look, it would be an almost perfect inflation hedge if you had held, this was published in 1980, if you had held over the last 20 years a basket consisting of ammonium nitrate, copper, aluminum, and plywood. How did he pick those four commodities? He had to go back and do a grid search and see what combination of commodities just happened to go up and down with the CPI. So I had a grad student say, look into how did it do after Hall published his article? How did the ANCAP bundle do versus the CPI? And it was all over the map. It was way up, it was way down. He had picked it. You can always pick a winning stock portfolio in retrospect. This is kind of the same problem. But even if you pick a broad index of commodities, so here's a hypothetical 22 commodity unit of account bundle, even that didn't maintain its value so well in terms of the consumer price index. So it's going to take some research to find a robust set of commodities if you want to match the performance of the CPI. There's my picture of gold doing well historically. All right, well, thanks very much.